This week we traded from December 2nd to December 5th, only 3 trading days in total, and the final outcome for the week was negative. Before going into the day-by-day review, it's important to point out the core issue of this week. The market structure was a clear range, yet our executions carried a trend-biased expectation. This mismatch between structure and expectation explains most mistakes, so we'll go through each part chronologically and reflect on how these decisions formed. At the beginning of the week, the market opened with a gap up, extending the upward move from the previous week. Inside that prior uptrend, we identified 2 key areas: the zone where buyers concentrated their aggressive effort and the area where earlier shorts were trapped. These 2 zones defined our support levels for the first trading day. When price pushed into the upper resistance during the European session, we chose not to take the breakout long because the overhead pressure was obvious. Price then pulled back to support, and we observed some short absorption. However, at the same time, there was also a large amount of resting short supply, meaning shorts might continue to add positions. Given this mixed order flow and the fact that we were near the middle of a structure rather than an extreme, we held off, which was appropriate. Still, even though we acted cautiously, we did not fully internalize that the overall environment was shifting into a range. Moving into December 3rd, price broke the first support but reached our strongest expected support lower down, the region corresponding to the main wave of earlier aggressive buying. Here we again saw aggressive buy orders stepping in, forming a clean support-resistance flip. This was the first proper long opportunity of the week, but we didn't take it. Later, when price dropped sharply a second time, we attempted a long on the first rebound. This entry was premature. The signal candle was weak and there was no meaningful absorption from large buyers. Meanwhile, overhead short absorption remained, which meant the pressure above had not been cleared. As a result, this long attempt was essentially catching a falling knife and ended in a loss. The next opportunity was much better. Around the 4,200 key level, the 15-minute chart printed a signal candle with significantly higher volume than previous bars. Both long and short aggressive orders appeared, showing strong two-way activity, and the candle closed holding the major support zone. The next candle confirmed strength, and this setup aligned perfectly with our criteria. A key level, large lot absorption, strong signal candle, and clean confirmation. This long worked and pushed back toward the previous high. This trade demonstrated that when the location is correct, our methodology performs exactly as intended. On December 4th, however, the main issue resurfaced. The entire structure was a range, but we continued to look for breakout-style long setups near the top of that range. After price made a higher low, we took a long, but this ignored a trapped long zone above acting as resistance. The signal candle also lacked strong volume. Because this area had already shown consolidation and previous long trapping, expecting a clean breakout was unrealistic, and this trade was stopped out. Later, after observing what looked like another support-resistance flip, we entered another long. The logic seemed valid. Absorption beneath, a retest of structure, and the key level holding. But again, this entry overlooked the fact that 2 aggressive short blocks were stacked above, forming a layered resistance. Even if the long worked initially, the achievable reward was limited by these overhead supply levels. Expecting a large move from this location was not reasonable, and the trade failed as well. The final long of the week had a similar issue. On the 1-hour chart, we saw heavy volume, strong long absorption, and clear two-way trading around a key zone. If price could hold there, a range bottom could form, so the idea itself was not wrong. But on the lower time frame, the local structure hadn't confirmed. The market failed to stabilize and broke through the level. Despite the presence of meaningful absorption, the range environment required patience, and the failure to hold the level resulted in another stop. By reviewing all 3 days together, the higher timeframes make the situation very clear. From December 2nd to December 5th, the market was in a well-defined range. Both the upper boundary and the lower boundary were tested multiple times with no decisive breakout. In such environments, the correct approach is simple. Look for longs near the bottom of the range, look for shorts near the top, and avoid expecting trend-like extensions in the middle. Our main mistake this week was applying trend-based expectations inside a range and taking long setups at structurally poor locations with limited potential reward. Another core pattern emerges when comparing the successful and unsuccessful trades. When we positioned at a structurally correct level, such as the long at 4,200, the trade behaved cleanly. But when we took trades near resistance, even with good-looking entries, the trades consistently failed because the location did not support the expected reward. This shows that the problem wasn't technical skill or reading volume. It was the mismatch between location and expectation. Going forward, the adjustments are straightforward. Structure comes first, signals come second. A strong signal at a bad location is a bad trade. In a range, we cannot assume breakouts. We must wait for the market to prove them. High reward to risk opportunities only exist at extremes, not in the middle or near resistance, and we should avoid acting on weak signal candles, especially when volume doesn't support the move. Overall, this week's losses did not come from misunderstanding the market, but from giving the market more trend potential than it actually had. We identified all the correct key levels, but we still opened trades in places where the reward did not justify the risk. By respecting structure more strictly and anchoring our expectations to the location rather than the hope for continuation, we can significantly improve the results moving into next week.